So that was like the deal where I was like, okay, I'm putting all my chips here, and now I'm sort of have nothing at this point. And once I'm done, and it was enough that I was able to move away from my job at that point. But then I couldn't grow anymore.
All right, welcome back to the next episode of Angels, Exits, and Acquisitions. Thanks so much for being here. I'm your host, Jeff Barnes. You'll have to forgive the little scratch on my forehead here. I was playing some basketball with the kids over the weekend, and they forgot to trim their nails before trying to take Dad on. So I got a couple injuries and some soreness to work through, but that's okay. So I just had Michael Pouliot on, and we talk a lot about real estate investing and raising capital for real estate projects, and that genesis and metamorphosis of the real estate investor to real estate entrepreneur to maybe even fund manager and multi-billion-dollar property owner. So really great conversation that we had about how you get started, what you should be thinking about, and then how do you raise the capital for your project so you can actually take your business to the next level. And again, this could be whether it's in real estate, private equity, or even in angel investing and setting up a fund possibly. So looking forward to hearing your comments about this episode, and thanks so much for being here. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
Hello, welcome back to another episode of Angels, Exits, and Acquisitions. I am your host, Jeff Barnes. I'm here today with Michael Pouliot. Michael, how are you doing today?
I'm doing great. I'm looking forward to this.
Wonderful. Well, I appreciate you being here today, and we're really looking forward to diving into your background and learn a little bit more about what it is you do. So why don't you go ahead and tell folks a little bit about yourself?
Sure. Yeah. Thanks, Jeff. Thanks again for having me on the show. My background is I'm a real estate investor, and buy apartments. I help people get their first opportunity in real estate. I'm a father of 3 young children. I'm married, and I live in Boulder, Colorado. So that's the short version, I guess, of my story.
Awesome. So, you've been a real estate investor, raising capital, investing in different types of real estate along the way. What got you involved and started in that in the first place?
Sure. So I started my career on Wall Street. So that's what I anticipated doing with my career was worked J.P. Morgan and Merrill Lynch early in my career, and thought I'd be kind of like a Wall Street person. And after doing that for some time, I realized the 12-hour days, 2-hour commutes each way were just I wasn't getting what I wanted to get out of life. And so around the time we had our first child, that's when I decided, hey, I'm gonna look for something that is going to give me time freedom. It's going to give me financial freedom. And that's when I started investing in real estate. This is about, almost probably 10 years ago at this point. And, kind of snowballed from there. So just started with single family homes, worked my way up from single family homes to larger and larger properties. And at this point, we've done over $1 billion of acquisitions all over the country in housing, single family, multifamily, mixed use, industrial, what have you, just all over the place. So a lot of things have happened since then, but that's, I guess, the short version.
Awesome. So obviously working on Wall Street, you got to see some different things in the finance world and, learned quite a bit about that. But it's generally a different kind of leap into real estate, right? There's creative financing. There's, dealing with banks and dealing with sellers and dealing with all different ways of financing property. But what was it that made you say, hey, you know what? Real estate's the thing that I really want to throw my hat in the ring and try this out, right? You said, you were tired of the, excuse me. You were tired of working long hours, but you didn't know, what else was out there probably, I'm assuming at that point. So why was it that real estate investing really appealed to you?
Yeah. So my family has been in real estate for a little while. My father was a builder, and so I was spending my summers and breaks on job sites, digging holes and leveling. Nothing too interesting, but going and grabbing a toilet from a vendor over here, bringing it to the house, and sweeping things up. Just doing a lot of like the day labor type activity. And so I got to get to a good sense of the construction side, the physical aspects of real estate. Never really got a sense from my family, the structure side or like the investment side. It was mostly the physical part. So I got pretty comfortable with that. And then and then I think, just from starting to look at the education space, see what was out there, between Bigger Pockets and a few other mentors and things. I just said, hey, I have a good sense of the physical piece of real estate. I understand kind of the construction, the project management piece, which I think is maybe a barrier for some folks. And then on the other side, with my Wall Street background and my finance background, I felt pretty comfortable underwriting deals, analyzing deals. And so you kind of put all that together. And I said, hey, I can do this. And in the mid 2010s, rates were low, prices were still pretty depressed. It was I think it was easier than it is now to go out there and find property, acquire that property, finance it really cheaply, get great leverage, and then, be able to recycle your capital. And so I had the benefit of a good, good foundation, but then learned along the way, of course, as well.
Awesome. Yeah. Like I said, there's so much information out there nowadays, like I said, Bigger Pockets and podcasts and on and on and on,
Mhm.
that when somebody's looking to make that leap into this kind of world, generally it's as a side hustle initially.
Mhm.
And they kind of get their feet wet, so to speak, get their hands dirty and realize, man, it's actually a lot of work, right? Whether you're watching the shows on, HGTV in the doctor's office or wherever, you see all these fix and flips like, oh, no big deal.
Right.
We raised a few $100,000 and we made $500,000 in 72 days. Like,
Mhm.
well, that's really glamorous, right? But that's not
Sure.
always the way it works out, is it?
No, it's not. And that's how I started too. So, as a side hustle. So I was working at the time. I had left Wall at the when I bought my first house for investment. I left Wall Street at that point and moved into financial consulting. And so I had a little bit more flexibility in my job, but I was still in office. So I wasn't able to like devote full time to it. And so there was a lot of working nights and weekends and taking calls, out on lunch hours and working sending wires here and getting lien waivers figured out and all this different stuff. But it was very much a side hustle to start. And what I found out, very quickly was that there's a lot of talk about, oh, you work in single family, you make a couple $100s per unit in cash flow passively. But if you're really trying to build a business around it and go full time, a couple $100s a month in cash flow really doesn't get you very far. Especially, even if you stack 10 houses together and you bring a bookkeeper on or a project manager, all that money's gone again. So, because you got to pay those people. So if you're just looking for it to be a side hustle and there's no business expenses, maybe that cash flow can be great. Because you're not really valuing your time. You're the one doing all of the labor. And so you're not attributing any costs to your labor hours. But if you start to actually hire people, project managers, administrative assistants, bookkeepers, things like that, very quickly, you need to have a pretty decent stable of properties just to cover your expenses. And so I realized that pretty quickly. And that was what led me ultimately to say, hey, I got to do either a higher velocity of deals, I got to do more deals, or I have to do different strategies. Maybe I got to start fixing and flipping so I can get sort of like some chunks of cash in the door, or I have to go with bigger properties. And so I ended up doing a combination of all of those things. But yeah, the single family route, it was a little jarring for me because I was like, hey, I'm working so hard and I'm doing so many deals, but I feel like I've done this for 2 years now. I've done 20, 30 of these things, and every month I'm still just taking my cash flow and paying my bookkeeper to just do the books, just so that next month I know how much money I didn't make. So it was an interesting process, but it definitely taught me a lot about scaling and project management and all the it's good to start with single family, but it does take a lot of scale to get you where you want to go, at least in where I wanted to go.
Well, I'm really glad you said that. I was hoping you would because I feel that there's a difference between someone who's a real estate investor and
Mhm.
a real estate entrepreneur, right? Somebody who invests in real estate passively because they want to build up, wealth over time. Like you said, maybe they get a little bit of cash flow every month, and maybe they're managing it themselves as a long-term rental. But really, what they're looking for is that long-term appreciation and the tax write-off in between. It's not spending out a lot of cash. On the other hand, there's those people that want to build a real estate business.
Mhm.
And we were talking, or one of the things you'd mentioned in your intake form here was um, real estate private equity,
Mhm.
which I'm really curious what you mean by that and how you made that shift. But it sounds like you said, listen, it's great that we have real estate in our portfolio as an investment strategy, but this is not going to pay the bills. So, like you said, you made this leap, you made this decision. Hey, we need to find a way to turn this into a real business to actually grow our wealth and make cash flow along the way. So, talk to us a little bit about what you mean by a real estate private equity and how you actually turn this into an actual business.
Yeah. So yeah, my initial I'm very goal oriented. And so my initial goal was I want to leave my W-2 job and I want to become a full-time investor, entrepreneur, et cetera, and sort of spend my time on what I want. Now I would say that that does not mean that I don't work. I probably work harder now than I did before. But at least I'm the only one, I'm the one pushing myself to do it. No one else is telling me sort of what to do, which is sort of the goal initially. But I probably work twice as hard, if maybe more than twice as hard as before. Now, what happened was, like I had said, I had done a bunch of these opportunities, these BRRRR deals where I would buy them, I'd renovate them, I'd rent them out, and then I'd refinance so I could recycle my money. And I realized, hey, I'm sort of treading water here. I'm in quicksand a little bit. And I'm juggling all these loans and all these little projects, tiny little projects. So each one of these houses was $50,000 to $150,000 in Philly, was kind of where I started. And so I said, okay, I'm going to start doing some flips. And so I started doing flips at the same velocity I was doing single family rentals, probably one a month. And then it was still, post, GFC. So there were still some foreclosure deals on the markets and stuff. So I did a lot of pre-foreclosures and foreclosure deals, really easy flips, nothing too crazy, nothing, things I could get in and out in like 3 weeks, so far as the construction. And I did those for a while, but then again, like same kind of thing. You got to wait, one every 4 or 5 houses doesn't sell as fast as you want. Maybe you make some money on it, but really it just takes a lot of time out of your day to say, oh, okay, I got to keep up with this house, what's going on with it. And so that's when I realized, hey, I need to start buying larger properties where one property, one project I can spend a lot of time and effort on, which is pretty much the same amount of time I'd spend on a single family. But I could have a lot more cash flow on the other side of the deal, right? So that's when I started buying. My first multifamily was a 36 unit, or I bought in some like twos and threes, like duplexes and stuff. But so far as 5+ units, that was my first one, was a 36 unit, very distressed property. I bought, $25K a unit, right, for 36 units. But same strategy, the BRRRR method. I was going to go in, renovate all the units, do it as fast as I could, re-tenant them up, and then sell the property or refinance it. I ended up refinancing that property, and I made a lot more cash flow. But I basically had run out of money at that point. So that was like the deal where I was like, okay, I'm putting all my chips here, and now I'm sort of have nothing at this point. And once I'm done, and it was enough that I was able to move away from my job at that point. But then I couldn't grow anymore, right? The money was either in the properties, or I was coming to me in cash flow, and there wasn't just a lot of maneuvering I could do. So I said, well, I've spent all this time, I've done all these projects. I need to go out and try to find folks to raise money from, to do joint ventures with. And that's when I started to do, raising money. And when I say a real estate private equity firm, that was kind of the beginnings of that. Was, okay, I'm going to go out into the marketplace. I'm going to show people what I've already done. I'm going to find an opportunity that's similar to what I've already done. And then I'm going to present that opportunity to other folks in the industry who are investors who want to find operators like myself, emerging sponsors, new folks, that, maybe I can't negotiate the best deal for myself, but they get a really great deal. So they get a great deal. I get the capital. They get access to the deal. It's a win-win kind of symbiotic relationship. And that's how I built, the business from there, and purchased, another, thousands and thousands of units since then, have been on the back of, this symbiotic relationship between investors and us as the operator.
All right. So you just gave us a lot right there. I'm going to unpack these things because, for anyone who's not gone through this process, what you just said is an oversimplification, right? Like, let's be really clear here. The amount of work that I can imagine you had to put into making that transition, not to mention the stress, and married and had kids, right?
Yeah.
A kid. But at that point, when you say, all right, I'm going to finally leave having a job, a W-2, because I'm able to buy a property that could cash flow me and replace my cash flow. Up until that point, it was all your own money and your credit, is what I'm understanding, right?
That's right. Yeah.
Yeah. How did that work out on the marriage? I'm just curious.
Well, my wife is very supportive, and so she's always been really supportive. I think we've only now looked back and said, was it like, you know, I would left a career where I could have made, where I was making really good money, and then I was very likely, with a very high probability, going to make more money than almost anyone as a trader on the fixed income desk at J.P. Morgan, and I was on that path. And then to go and to move from that to be an entrepreneur with a much higher failure rate, I think she didn't really understand necessarily, or we didn't collectively understand, the expected value of those two opportunities. But I mean, I wouldn't trade it for the world. I mean, we've been able to move across the country from New York to Boulder, where we live now, have more children, spend our time the way we want to some extent. Obviously, a lot of times it's the children who are dictating how we spend our time with the school schedules and
It
whatnot.
is these days, isn't it?
Um, but sort of, I get to spend the time how I want it. No one's calling me up and saying, "Hey, you have to do this by tomorrow." So yeah, I mean, my wife has been very supportive, but yeah, I think having a spouse that is supportive of what you're doing, or at least aware of the decisions that are being made, I think is really important, because otherwise you may find yourself in a couple of years or even a couple of months not where you want to be. Yeah, so.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah, I bring that up. It's tongue in cheek a little bit, but it's an emotional toll, right? To
Mhm.
go through that high paying 6-figure plus job that there's quote unquote stability and security. We all know that's sort of a myth, but
Mhm.
at least it's relatively assured compared to going out on your own. And like I was saying, you were using your own credit and your own money acquiring these properties, but then you went into you said it was a 36 unit apartment building. You can't just go down and get a, Fannie, Freddie kind of loan or anything like that. So how did you finance that first multifamily property?
Yeah, so it was pretty. Looking back, I guess it was somewhat challenging. For at the time, I just said, "Hey, I have to get this done," and there was just no other choice. I had to kind of like, claw my way to it. So basically, I took out a hard money loan to do this project. I flew. This happened to be in Chicago. I flew to Chicago to meet with the bankers or whatever to justify that I could do this, because at this point I had never done a multifamily project before, and so they were suspicious. And I remember that meeting. It was with a company that's definitely grown. It's called Renovo at this point. It was called Renovo at that time too, but they've definitely grown. And I sat in that meeting. And I said, "Listen, I'm going to build this business. I'm going to buy $1 billion of real estate over the next 10 years. And this is going to be the first project I do." And they're like looking at me like I'm a crazy person. And, 10 years later, I've done it, or, with the help of, a fantastic team. I don't do this stuff myself. So I went, I had this meeting with them. I justified kind of the business plan for that project. I justified to them what I was going to do long term, which is sort of like a little bit of a carrot to say, "Hey, like, you do this deal for me, we're going to keep doing more and more deals. I'm going to keep bringing you more business." They ultimately funded the loan, and they were a great lending partner for me initially. Expensive for sure. Would have been more expensive now, but at that time expensive. And they gave me quite a bit of leverage on the deal, and I was able to get into that deal and do the work I needed to do. But
Yeah. So for anyone who doesn't understand a hard money loan, roughly 50 to sometimes upwards of 70% loan to value,
Mhm,
not of the after repaired value though, right? Like
mhm,
that's what a lot of people think. Oh, well, it's going to be worth $1 million, so I can get $700,000 and I only need 500K. No, that's not generally the way it works, right? So
mhm.
like you said, it can be fine. It can be expensive. Be at points and double digit APR and things like that, and short term, right? I'm
Yeah.
assuming somewhere in the neighborhood of 24 to 36 months at most. What
Yeah,
did you got?
yeah. This was I think I about, I think, 18 months on this initially, but there was a couple extension options. I was paying like 1 or 2 points up front and then 10% interest. And I negotiated a little bit, as much as I could, but nothing too crazy. I did get quite a bit of leverage though. I think I got 75% of the purchase and 100% of the renovation. So I was putting 25% down, and then the idea was that the project would be able to cover the, operating expenses even while I was doing it. It wasn't necessarily true, but I did have some reserves. And then ultimately the project turned out better than I thought it was going to, so far as what we could get for rents and things like that. And then as a result, it was able to kind of take care of the cash flow, because we bought it for 25 and then ended up being worth, 75 or 80 a door once we were all done.
Oh, wow.
We only spent 20K a unit. It was a very old property, 100 years old. So even though we were making really good cash flow, it was like, okay, well, every year we've got to, allocate quite a bit of money to, the boiler or the roof or the tuck pointing. And, those are very expensive things. And so I learned also very quickly through that project that cash flow of what it shows up on the P&L doesn't necessarily mean it's cash flow you can consume. A lot of that money needs to go back into the asset to support the physical asset and ensure that you can protect that asset over time. Especially, and then if you're in an area with overbearing city, you may have a lot of violations related to those work requirements, and then you have no choice but to repair them. So.
Yeah, absolutely. And so, again, I wanted to dive into that a little bit because I know people who've gone through this whole process, right? And it's not easy. On the surface, it sounds great, right? Oh, we can buy it for 25K, maybe we can sell for 50K a door, and there's a little bit of work we got to put into it.
Mm-hmm.
But the time and energy that you have to put into every little piece of this, especially when you don't have a big team yet.
Sure. Well,
and then building a team is a different story.
Yeah. So I think, I was at that time, I had a really great contractor. I was living in Colorado at the time, and this project was in Chicago, right? So I had to rely on having some really great partners locally in Chicago from a property management perspective, a construction perspective. Also, having your lender is your partner in a lot of ways. So having the lender going out there, conducting inspections, getting lien waivers done, making sure that I'm not exposed, they're not exposed in the event that, someone says something was done that it wasn't, which happens all the time in construction. And then I was, at the time, flying the red eye to get to Chicago, same day trips. So that I had a young child at the time and my wife was there. And we were in a brand new place. So I would fly, I'd take the first flight in the morning, 6 a.m. I'd get to Chicago by 9, and then I'd stay there all day. And then I'd take the last flight back home. And I would do that pretty frequently until this project was, where it needed to be. And there were quite a few bumps along the road. We had the city shut us down for work that we were doing, even though it was totally compliant. We had, the city shake us down for certain things. There's just like a lot of city related things, some light crime in the area for sure. Some vandalism, situations we had to do more work than we thought. So there was definitely a lot of issues that occurred throughout the project life, because it took about 2 years to go through the entire thing. But, in the end, it was totally worth it. And it did, it was that foundation, that springboard to all the other projects they've been able to do. And I learned a lot on that project to be able to we ended up doing about 10 more projects in that, 50 block radius of the same size, all in that next 12 months, based on the success of that single project as the case study that we could then go out and say, hey, we've done this before in this area. We know the rents, we know what it's going to cost. We know the expenses. We have all the partners ready. Let's go. All I had to get was the money. So then we were able to go out and find the money. And that's how, it really built the beginning of that business.
Yeah, that's awesome. And it's so important to understand, like you said, that the money was expensive. The project sounds like real pain, everything you're going through. I remember days like that when I would, I'm on the West Coast, so I'd fly from Seattle down to San Francisco and back the same day and do that sometimes a couple times a week. And it was just like, oh man, this is kind of a lot.
Yeah.
But the important thing was, and I truly believe this, that we all cut our teeth on something that everybody looking back on, we're like, wow, would we really do that today? No, probably not. But we had to go through that because that was, like you said, the springboard to everything else that happened. And the amount of learning that happens. I mean, you can listen to podcasts like this one. You can read books. You can go to seminars. You can go to conferences. You can talk to all these people that have gone through. You go to, all the the networking events. And yet you still have to go through that, right?
Mm-hmm.
Because it changes you as a person. And that's what allowed you to then jump into this world of, hey, I want to go and do bigger and better deals and start raising capital, which is, again, a completely different skill set than I want to rehab this apartment building.
Yeah.
To make it worth money, right? Now, you have a CFA, if I'm not mistaken, a chartered financial analyst. So you have a little bit of background when it comes to finances and money and things like that.
Mhm.
How did that play into your role as a capital raiser now?
Yeah. So in the beginning, I was living in Boulder. And so I was just looking for people who I knew were already investors. So I just networked with other investor clubs and local, events and tried to have conversations with folks. So far as how the CFA helped, I think it was mostly that helped me have the foundation around analysis and relative value and just not looking at real estate in a bubble alone by itself, like as this that returns are all like a trade-off of alternatives. And so, you have to think about real estate as something that is both for you as an investor and then when you're going to raise capital, that this is just an allocation for the people that you're working with. And so if you're looking to get a 15%, 20% return for them, that might make sense in certain markets, other markets, and maybe 10 to 15. And they're looking at your deal relative to all the other deals they're getting pitched in that space, and then all the other deals they're getting pitched in every other space. And so you have to really think about that. You're competing for those dollars somewhere else. And so just having a good framework for how fixed income works and equities works and then all the other asset classes within real estate and then commodities and currencies. And then, I also have the CAIA designation, which really covers a lot of alternative investments like music rights and timber and anything else you can imagine that you'd have to value. And then while I was in financial consulting, my primarily what we worked on was helping our clients understand like complex securities, complex situations, bankruptcies, workouts, things like that. So there was a lot of discussion and analysis around what something might be worth relative to a set of alternatives or relative to comparables or whatnot. So I think that's really how it helped a lot, was really in the valuation space, understanding, hey, is this a good deal based on other things that have traded, on the alternatives that exist, and then using that knowledge and that expertise to help explain that to investors and say, hey, this is a good deal because of, these 10 or 15 reasons versus just having more of a surface level knowledge of, well, I found the deal and it's saying a 7% cash on cash. So that's good. Well, what does that mean relative to, the 1,000 of other things that you could be looking at?
I think that's really important for anyone who's listening to this or watching this to take away, which is, a lot of people love this idea of real estate, love this idea of entrepreneurship, love the idea of building a really big company and doing that. And somewhere along the line, most people realize I need to raise money, whether that's $100,000, a million, or $100 million. There's a process that we all have to go through when it comes to raising capital, and understanding what makes a deal a good deal for an investor is so important. In fact, one of I do these little snippets and I share info in our email marketing and on my socials with people, which is the number of reasons why your deal won't get funded or why you can't raise capital for your deal. And the number one, I feel, is that your deal is really just not that good, right? It doesn't pencil out for the investors. And people don't realize that because they haven't spent the time to really go through and analyze it. Like you just said, and I want people to understand this, I call it your unique investment proposition, right? Which is, why should I invest in your deal over and above every other opportunity available to me, including just putting my money under a mattress, right? And like you just said, there's so many opportunities that people have who have money, whether that's a bank, private equity firm, venture capitalist, a real estate investor, just a high net worth person. They have so many opportunities available for their money that you really have to be able to convince them that this is a good deal for these reasons. So I think it's important that people go back and re-listen to everything you just said about or how you analyze the deal and what you're looking for and how you're comparing that against all the other things they have available to them.
Yeah, no, definitely. It's that's one of the most valuable things that I think you can be thinking about when you're looking at opportunities from the lens of it into the marketplace, right? So you're out there looking for opportunities, and you have to select a deal that you ultimately are going to invest time and energy in to do the underwriting, bring it through due diligence, try to find the loan, all of that. But you really the equity is usually the hardest part of the deal structure to convince of participating, or at least that's That's always how it is in the beginning, is the equity is the hardest. I think it does change over time, where it ends up being that it becomes a little bit easier to find the money, and then you just become more discerning on the front end about which types of deals you do. But in the beginning, for sure, you want to make sure that you're finding a really good deal. And I find that when you're just starting out, if you're just looking to raise money for the first time, the best thing to do is not to try to do this just in time type work where you find the deal and then you have 30 days, you go on the clock, blah, blah, blah. Get a sample. This is something that I was taught when I was started, like put together a sample deal pack of a deal that you think would be consistent with what you typically would see in the market, what you could find based on the underwriting and the work that you've already done looking at deals. Put that deck together and then go talk to 10, 20, 30 people in your area that are investors that invest in these types of opportunities, passive deals, and just sit down with them, have it be informational, ask them like, hey, if I found a deal like this, would this be something you would be interested in? So you're sort of like pre-selling them on the opportunity, but also getting a sense of their buy box. What are they interested in? What is your minimum threshold for year one cash on cash? How do you look at exit rates or exit cap rates? And what's conservative here? What's aggressive here? And that gives you a better context for understanding how the investor looks at things. And then you have that 10, 20, 30 conversations. All of a sudden, generally speaking, what the investor community is looking for and whether or not what you think matches that, because that's the most important part. And then you probably also now have a good number of people who will invest in your deal when you bring it up. So now you're not going to be as concerned or as stressed about, you'll still be pretty stressed, but you won't be as stressed about it because you say, hey, well, I talked to 30 people. 12 of them said that if I found something like this, I would, bring it to me. And then all of a sudden now I know, okay, well, 12 people said yes before the deal came. Maybe I've got a couple $100,000 right there of cash ready. So now I can go out and say, hey, I'm going to look for $1 million deal because I have a couple $100,000 of, sort of soft circle dollars. And I know that I've had 30 conversations. I can go have 30 more and get another couple $100,000 or another 30, So you have all that confidence. I would recommend that anyone looking to raise capital considers doing that sort of pre-selling process first. Have conversations in advance of having a deal, because there's a lot of things you have to do when you have a deal, and you don't want to get distracted by the immense amount of stress of having to raise capital in a 30 to 60 day period which is typical for real estate. Or at least if you can minimize that stress as much as possible, you'll make less errors, and you will make errors on your first deal. And so the less stress you have, the less errors you'll make, and then you can do a better job of analyzing that deal, doing the due diligence, and making sure that the investors end up getting what you described to them, which is a good deal that performs well over a long period of time.
Yeah, that's awesome. So we call that digging the well before you need the water, right?
Yeah.
It's so important. It's so, it's such a missed step for a lot of people. They think if I just get the deal, the money will come.
Mm-hmm.
But that's only true once you have a track record, right? Like you said, that it gets easier to raise the equity as you go. That's because you've built up the track record. You've also built up the trust. Like a lot of people, I'd imagine the vast majority of your investors are probably reinvested with you over projects, right?
Yeah, that's right.
Yeah. So that's how it ends up getting easier. So anybody who's going out there and starting to raise capital for any project, I would encourage you, again, go back and re-listen to what Michael just said, because it's so important. So Michael, you've done over $1 billion in transactions when it comes to real estate. What's next for you guys?
$1 billion a year? No.
I like it.
Yeah. So yeah, I mean, eventually I'd like to be doing that sort of volume per year. I don't know that, we don't really have dollar amount goals per year necessarily. We try to be doing a deal every quarter, but it's really market dependent. So we have a certain set of standards that we stick to, and if we can find opportunities within those standards, then great, we're going to want to do that deal. And the market will tell us what we can do. So it's really not up to us. It's not like we just pick these flowers out of the garden and then they're ours. There are a lot of our processes are competitive and things like that. So our goals going forward is this year we spent a lot of time, this year, I guess it's January now. So last year we spent a lot of time vertically integrating the company. So now we have our property management in-house, our construction management in-house, and we're just starting now to bring a lot of contract services in-house, like our landscaping and a lot of things that we were typically paying sort of an arm and a leg for before. Pest control, snow removal, blah, blah, blah. So bringing all of those things in-house, vertically integrating has had a huge impact on our operations, our ability to stick to budgets, control our people, incentivizing them properly, and making sure that we have all of the right pieces in place to scale from our current platform up. So that was a big effort for 2024. Going forward, I think the market's starting to normalize a little bit. I mean, in real estate's a little bit tricky. I don't know if I would say, I think over the next 36 months, we'll continue to see more and more normalization. I know that's a sort of a long period of time in this world that we live in, but real estate is a slow moving kind of a behemoth. So I would say, over the next few years, we'll see more normalization. We'll be able to leverage that vertical integration to acquire more and more properties. This year, I'd love to get 3 or 4 projects done. Most of our projects are between $10 and $50 million each. So I'd like to be able to buy somewhere in the $50 to $200 million range. We have our first deal of the year that's going to close here in March, and I'm going to hopefully be able to find a couple more, in the springtime. And actually, right after this podcast, I'm headed to NMHC, which is in Vegas this year, which is kind of the annual conference for middle market real estate, private, particularly apartments. So I'll meet with all the brokers, and hopefully they'll have some new opportunities for us to take a look at. So that's really the big focus, is continuing to spread our message, doing podcasts, things like that, expanding our equity relationships, expanding our deal relationships so we can find more opportunities, increase top of funnel. And then now that we have that operational base, continuing to strengthen that, bring more and more stuff in-house. That's the focus.
Beautiful, beautiful. So one last question for you before we wrap up, which is, knowing everything you know now, having gone through all the ups and downs and the market twists and turns and raising capital and, doing over $1 billion in assets under management and real estate transactions, what is one piece of advice you would give to your younger self that's just about to embark on this journey?
So I think, I don't think I would change. I don't think I would change anything. I think, if anything, I would have bought more faster. I would have probably looked to raise money faster, start having conversations with folks, quicker. I think I ended up doing maybe a year's worth of deals more than I needed to do, and before I started to say, hey, I have enough experience to start raising third-party capital. And if I had done that, I would have been able to probably buy a lot more during that, before the most recent peak in 21. And so I would say, if I had immersed myself more, left the job, I guess just start buying more real estate faster would probably be the solution. And so that's what, one thing that we didn't touch on was that, we have the private equity real estate company, which is fantastic, and that allows us to continue to scale and buy large properties. Also have a real estate services business where we help individuals get their first deal or scale out from single family to commercial. And really, we think about that platform as an opportunity to help people get educated, become deal finders, either for their own business or to bring deals to us. And so we have a deal desk concept where people will bring deals to us, and we'll partner with them on those opportunities and help people take that first step from W-2 or whatever they are to either a full-time investor, if that's what they want to do, or if they just want to, have a side gig like you had talked about and just have a few in their portfolio. We can help with that as well. And we really do that through our free resources inside of our education community. So
Beautiful. So do more deals faster, learn how to raise capital, or start raising capital sooner, right?
yeah.
Perfect. Love that. And that kind of goes into my next piece, which is, so how do people find out more about you, and where can they go learn about, Michael Pouliot and everything you're doing?
Yeah, so really easy. Just go to michaelpoulio.com. There, basically, you can go anywhere, and you can get to our free education community from there. You can also go and subscribe to our newsletter at Carbon, so you'll be kept up to speed on what we're doing, as well as any new opportunities that come around. And then also, I post a lot of thought leadership articles, etc., on there, and then also various podcasts and stuff. So yeah, check it out, michaelpoulio.com, and hopefully you'll gain some value from that website.
Beautiful. We'll make sure to put all those notes in all the notes into the show notes for the podcast.
There you go.
And thanks, Michael, so much for being here today. For those of you that are watching or listening to this, make sure you subscribe, like and share this podcast if you got some really good information out of it. And Michael, thanks so much for being here.
It was a pleasure. Thank you for having me, Jeff.
Take care.